Nuestro siguiente expositor es graduado con honores en Ingeniería Eléctrica, Arte y Medicina por las universidades de Texas y Stanford. Además, es CEO y fundador de MarketSite Data en Nueva York. Trabaja en el punto de encuentro entre la psicología de los inversores y de los mercados financieros. Como dijimos, es médico, es ingeniero, especialista en inteligencia emocional. Sus libros han sido publicados y son considerados referencias por diferentes organizaciones académicas. Sus investigaciones han sido publicadas en las principales revistas académicas y en libros de textos que incluyen medios financieros como CNBC, Wall Street Journal, Financial Times y la BBC. Con la conferencia Dentro de los Cerebros y los Mercados, el rol de la emoción y el proceso de inversión, recibimos al Dr. Richard PETERSON.
Muchas gracias para hablar. No hablo español muy bien, pero yo voy a tratar poquito well, forget it. I'm going to speak English, and there's a translation in the back, so we'll do that. Sometimes I'll slip into Spanglish as I go through this, so I'll mix it a little, but I'll try to stay consistent with English. Y muchas gracias a Iris y Liliana. Ellos tenían la invitación a mí para esta conferencia, so muchas gracias a ustedes. So I'll start with a story. When I was 12 years old, I was given a little bit of money to invest in the stock market by my father. My father was a professor of finance, and he said, take this money and see if you can make more money with it. And I said, what do I do? And he said, figure it out. So I took the money and I looked at some magazines, and I found a magazine that looked very smart, told me top 10 stocks of 1985. I put my money in those 10 stocks, and a year later I had lost 20% of my money. So then I thought, I need a different magazine. So I tried another magazine, and I put my money there, and a year later I'd lost 30% of my money. So I went back to my father and I said, this isn't very fun. I don't know what kind of experiment you're doing on your son, but I don't like it. What am I doing wrong? And he said, investing is about buying what other people don't want. He said, you don't buy what everyone else wants. You buy those things that are disliked, that are difficult to value or difficult to find, where there's uncertainty or where people are pessimistic. And I said, so you're a professor of finance, and you're telling me that investing is an emotional process. And he said, yes, basically. Once you've done the valuation of the company, the next stage is the emotional assessment. So I became very interested, both out of my own anger at not understanding how to do better and trying to understand the markets. So from a young age, I've been very interested in how do I understand the emotions that drive investors and that drive financial markets. So I'd like to start today with a game to illustrate a point. So in this game, I'm going to flash slides on the screen. Each slide will contain the name of a color. I want you to say the color of the letters that you see on the screen. Okay? So on the count of 3, I'm going to switch the slide. Again, I want you to say it loudly and quickly to impress the people around you with how good you are at this game. Okay? Okay? It's in Spanish. Okay. 1, 2, 3. Okay, somebody, very good. We win. Okay, otra vez. 1, 2, 3. Oh, verde. Soy psicólogo, so I have to be tricky, right? So there's some tricks. But seriously, we'll try this again, okay? Okay, 1, 2, 3. Azul. Now you should know that was coming, right? Okay, here we go. Anyway. So I'm trying to illustrate a point. So if you, in this experiment, what you saw was that we were taking a shortcut without realizing it. The instructions were to say the color of the letters, but what we were doing unconsciously was reading the word. Now, in markets, we know what to do. We have information in front of us, but we take unconscious shortcuts. We do what's emotionally easy, and that's often where the biggest traps lie for investors. So, as I said, since a young age, I've been studying markets and how people work in markets. And we now have a company that looks at investors from the perspective of individuals. We have an online personality test that over 20,000 investors have taken in 89 countries. We have a data business with Thomson Reuters where we scan all of the world's financial information from social media, news media, SEC filings, other sources, and we quantify emotional indicators as well as macro and economic indicators in that information. And then we also work with investors in coaching and training. So we work with some of the largest investment firms training their traders how to perform better. Now, the key to understanding investment psychology is to realize that there are two major domains of psychology. There is the individual psychology, and a lot of research shows that individuals make systematic mistakes. We make predictable mistakes in our behavior with money. This is a field of study called behavioral finance or behavioral economics. And there are best-selling books in the United States that show what many of these errors are. Now the question is, do these affect markets? So we know that there are individual mistakes, and we'll talk about those today. But do these individual mistakes collectively influence crowds of investors and affect markets? So to answer that question, we developed the text analysis software with Thomson Reuters that I had mentioned. To illustrate the individual biases, there's a phenomenon called emotional priming. In emotional priming, what you see is that images or words or events activate parts of the brain that lead to worse decisions or better decisions going forward. So we ran an experiment in which we offered people a choice. They could have $10 or they could bet on a coin flip. On the coin flip, if the coin landed on heads, they would win $30. If it landed on tails, they would win $0. So what's the expected value of the coin flip? Sorry? $15, yeah, 0 or 30. So we offered them guaranteed $10 or $15, but they had to bet on the flip of a coin. What we found was that half the people preferred the guaranteed money and half of the people preferred the coin flip, even though the coin flip had the better expected value. We then tried some experiments. We gave them a face before, a picture of a face, and said, tell us if this is a man or a woman. Now, what do you choose? Now, the face had an emotional expression on it. When the expression was anger or fear, people were 30% less likely to take a risk, to take the gamble, than if the face had a happy expression on it. So simply, what we call an emotional prime affected people. When we asked them, did that face affect your decision making? They all said, no. Why would it? It's only a face. But the reality was there was a 30% shift in whether they took risk. This happens when you read a headline in the newspaper that's negative. I remember at the bottom of the financial crisis in the United States in March 2009, there was a headline in the Wall Street Journal, which is one of the most widely read newspapers, that said, analysts see the Dow Jones average at 5,000. And at the time it was trading at, I think, 7,000, which indicated another 20–30% drop in the stock market. This was a terrifying headline. Now, of course, they didn't take responsibility for the fear. They said analysts say this, but they were reflecting the fear in the market. Now, the reason that these headlines come out at the bottom of the stock market is because of the way the brain is structured. Our brains are structured so that our emotions are down beneath the rational part of the brain. So 100,000 years ago, when our species of human evolved, it evolved with the prefrontal cortex being the center of the brain that distinguishes whether we are human or whether we are more like animals. And the reason this distinguishes us is it allows us to think abstractly and strategically. We can think of strategy and make plans about the future. Now, the emotional parts of our brain, which lie under this, react to impulses and short-term desires and motivations. And when they are engaged, when we feel emotional, it often takes the rational part of our brain offline. It ignores that part of the brain. That brain part of our prefrontal cortex no longer functions. So when you look at the brain and the emotional areas of the brain, this is where our motivation comes from. This is where emotions, where desire come from. These images of the brain are from experiments that I did, and what we found was that we could stimulate people in these areas of the brain. When we did this, they would take too much risk in investment experiments. That is, if we gave them a gamble where the odds were against them, but we were able to activate this area of the brain with happy words or exciting pictures, like pictures of piles of money, for example, they were more likely to take too much risk. Now, there's another system in the brain that drives how we avoid danger. How we avoid danger is related to a very distributed system in the brain. We learn about danger from our past experiences. So, for example, people who lived through the Great Depression were much less likely to invest in stocks when they were older. People who've lived through the most recent financial crisis, younger people, are much less likely to invest in stocks as well, because they see more risk because of what they've seen when they were young and impressionable. We have memories of loss, and those affect us. And the reason that this is a powerful system and that it's important is because of genetics. Because if our ancestors were walking through the grass in Africa and they thought they saw a lion in the grass, but they weren't certain, the ones who survived were the ones who ran away. The ones who died were the ones who went and said, I wonder if that's a lion. And they looked, oh, it is. And that was the end of their gene pool. So we have to identify danger. We've genetically evolved to avoid danger and to be tuned to danger. And there is evidence that we are twice as susceptible to fear and of loss as we are to the opportunity for gain. That is, we're so afraid of risk that we will leave potential gains on the table. We won't take advantage of opportunities because we're so afraid of risk. And that's not to diminish that there are real risks, but it's to say that quantitatively, this is a phenomenon that has been found. Now, we each individually react to information. We hear that the stock market is up 2% in a day, maybe we feel happy. We hear that it's down 2%, maybe we feel fearful. Sometimes, and usually, we don't know that we feel these things, but they do affect us. Now, there's another way that emotions affect us. We have long-term patterns of personality. These are affected by genetics, as well as our events early in our lives, like the Great Depression. So if we have a traumatic event early in our lives, and we are primed already by our genes to feel afraid, then we will be more likely to be afraid and never to invest in financial markets going forward. So we've tested people around the world with some free online personality tests. We've tested, say, 4,000 with one of our biggest tests called the Investor Personality Test. And with those 4,000, we found that there are very common mistakes that everyone admits to in their investing. Most people say that they hold their losing positions too long. When they know there's trouble, they don't get out, they stay in because they hope that it will return. We also found that people tend to, when they make money, they tend to cut it out very quickly. They take it away from the market so there's no more risk because they want to feel proud of themselves. Now, we found that men make much less money than women on long-term investing. Now, this was an interesting finding because when we broke it down, we found it's because men seem to try to take revenge on the markets. Men take losses more personally. They want to make back the money. They personify the market as an enemy, and they want to win back, so they fight the market. And as if you've ever fought the market, you know you're not going to win. The market always wins. So we've identified, using this personality test, that there are this personality test studies the 5 major classes of emotion, called the Big 5. These are on a scale from emocionalidad to estabilidad emocional, or extroversión a introversión, apertura mental, conservadurismo, etc. The spectrum of emotion, there are 2 of these, of the 10 that are listed, that actually correlate with investment performance. Any guesses what the 2 that correlate with performance are? We've tested this over 10 years through the financial crisis, and they're very stable. Anybody want to guess? Estabilidad emocional es uno, es one. El otro es apertura mental. It's openness to new experiences. Many of the best investors are big thinkers, like George Soros. I don't know how much he's worth, maybe $20 billion, gained through investing. And when you look at his activities, he's has the Open Society Institute in Eastern Europe. He does many projects to increase the circulation of ideas and thinking. And that's a very characteristic behavior of successful investors. I'm going to flip this slide. You're going to see an error, but that's not true. It was apertura mental was the other positive personality trait. Now, when we have a personality, when we have a certain way of thinking, in this case, Walter is thinking of negative things. So when we're thinking in a certain way, it's very difficult to change. Do you think Walter is going to turn his chair, dar vuelta su silla? No. ¿Cómo? It's up to him, yeah. But probably no. And if you're a woman, you say, no, Walter will never change. Men do not change. But you can change Walter. His personality can change. If you sit down next to Walter and you say, wow, Walter, what are we looking at? Oh, this is very bleak. This looks terrible. And Walter says, yes, it's very bad. Wow. So Walter, I wonder what's behind us. And you can turn around, but first you have to be in tune with Walter to understand his emotional state to turn him around. But fundamentally, we get into these positions in the markets. Sometimes we're looking off a cliff. Sometimes we're looking at a pile of money, and we think it's ours. Now, the way to get out of these short-term emotional influences is we have essentially a 5-step process. Now, when you think about it, when we're feeling afraid of investing, or when we're feeling extremely excited about investing, where we have what we see in the brain scans is this activity in the emotional areas of the brain. And the question is, how do we get ourselves in a more rational or analytical way of looking at investing? Because we know from our research that being in this emotional state of mind is very damaging to our wealth. And what we do, our first stage, is simply become aware, become present, say, I feel nervous. What do I do when I feel nervous usually? I don't do smart things. I tend to pull my money out of the markets, or I panic. And then when the markets go back up, then I jump back in, and then they go down, and then I panic again. When I'm nervous, bad things happen. And by acknowledging that, you decrease the intensity of the emotion. Then you say, now what's really happening? So re-examine the situation. Understand, how important is this? What's the urgency and the impact? That also decreases the intensity of the emotion by making it more rational. Then we look at our thoughts. What am I thinking now? Am I thinking I'm going to lose all of my money, or I'm going to become a millionaire or a billionaire in a few years? Is that what I'm thinking? If you're thinking like that, then you're not thinking rationally, because you're thinking about states that could be. To be a rational investor, you look at valuations, you do rational analysis. Now, rational analysis can include the emotions of others, but it shouldn't include your own intense emotions. Also, rational analysis is an emotional process. We found in all of our research on the brain that emotions are always engaged in rational decision-making. But the question is, when are they too far engaged? There are very good investors like George Soros say that emotions are essential to their good investment process because, for example, they use them for intuition or gut feel. When they have back pain, then they know that something is wrong with their investment position. By understanding those thoughts, it decreases the intensity. Then what we do is we try to connect back with our analytical processes, with the prefrontal cortex. Try to understand what's really happening and what can I do. Once you understand what you can do, take action. Whether it's, sometimes taking action actually means not selling in panic. Sometimes taking action means investing into the equity markets at a time when others are scared, because you know that that tends to be the best long-term strategy. As Warren Buffett has said, we buy when others are fearful. We sell when others are greedy. So for the long-term investor, the best is often to buy when others are fearful. But when others are fearful, we are fearful. So we've got to recondition ourselves. The major mistake that most investors make is when they become emotional about their investments, they continue to act. They take actions. They overtrade. They buy high, they sell low, again and again and again, until their wealth is eroded, until it's gone. So the key is to understand, what is my emotion? What has this done to me in the past when I felt this way? And then to recalibrate yourself. Remember, you cannot reason yourself out of a position you did not reason yourself into. So be careful. When we feel an emotion, we don't let it go for a long time until we've done something about it. After the financial crisis, I worked with many investors and financial advisors who said, I'll never get back in the markets. It's a rigged system. I don't trust anything. And the key was to understand, what can they trust about the markets? We spent a lot of time discussing this, and what I found was that as they worked through this process, they were much more likely to invest again. Even if they didn't trust some parts of the process, like high-frequency trading or other aspects, they did understand the idea of valuation, and they trusted that valuations would be stable over time, or at least have value. So, the market has cycles. We know that there are biological cycles in markets. When you look at the city of a major stock exchange, by its latitude on the Earth, you find that there's a seasonal pattern in returns. So here in Panama, you're not going to have much seasonal variation in your returns, but what we see is that the most northerly market, which is Stockholm, and the most southerly market, which is Sydney, Australia, you see shifting returns, that most of the return in Stockholm happens from November through April. Most of the returns in Sydney happen in May through October. When you look at markets again by latitude, you find that there's a diminishing of those excess returns as you diminish in latitude, and that those returns are inverted in the southern hemisphere. The excess returns are more than 20% annually over a study period. There's a good study on this. You can ask me for the reference after this. More than 20% annually to invest in November in Stockholm, sell in April, and invest in May into Sydney, and can just rotate every 6 months. Each market alone over the study period returned approximately 13%. So there are cycles and patterns in markets. Now, when do you think the market is most angry? When are investors the most angry? What is this? What month? Any guesses? April. I hear April in the United States because it's the tax reporting season. I hear that a lot. It's actually not April. These are angry references to companies in the S&P 500 index. We're counting them. In this case, it's all from social media. What we find is that September is the angriest month. And when you look at the last 15 years, the Lehman Brothers, the Asian currency crisis, etc., 2001, there was a big sell-off in September. September is a very angry month for investors. So what's the most optimistic month? December. Good guess. December. Now, even after we control for mentions, I hope you have a nice holidays, I hope you have a good new year, even when we extract that from our text analysis, we still find that people are most optimistic in December. The most optimistic single day is in the first week of January. So people are the most optimistic at the beginning of January, which makes sense because they're starting a new year. Why does that matter? It matters because we see cycles in these emotions, and the cycles appear to correlate with price action. These are cycles, the green bars represent when the short-term enthusiasm or sentiment is higher than the long-term. And the red represent when it's lower. So when sentiment is rising, the short-term rising more than the long-term, it appears to exert a pull on the markets. And then opposite. This is in the S&P 500 index. So we've branched out and looked around the world. How do we understand how people refer to business in various countries in the world? So like I said, we're partnered with Thomson Reuters. We're incorporating 2 million articles and social media mentions daily from over 2 million different sources and blogs and websites around the world. And what we find is that, in this case, we can track complex concepts as well. People reporting government instability in different countries. This is 2012. This is government instability around the world. You can see Venezuela because of Chavez and his cancer and the change in government there. So you can see this globally. This is interesting. And we've developed a number of different indexes that allow us to measure very complex sentiments and political themes and macroeconomic themes in the news around the world. So I mentioned that there are individual reactions to information that we need to learn to manage. And I mentioned some of the steps to managing those. I mentioned that there are personality tendencies, long-term states of mind that affect our investing. And now what we're going to look at are the media or the collective crowd emotions, and that affect markets as well. So for you as an individual, the first part of the presentation is about you and what you can do to help yourself. Now we're looking at the rational analysis of how emotions affect global markets. Now here's a comparison since 1999 of sentiment in Panama, Brazil, Colombia, and the United States. Colombia started out very negative and has since, as all the other countries, has trended upwards to the point where now Colombia is actually second in the ranking. Of course, Panama is number 1. And you can see the downturn in Brazil as well. What was interesting is this downturn occurred before the major market issues that happened recently. This summer, I should say. And now, actually, the United States is down at the bottom, unfortunately for us. So what does this mean for markets? Oops, okay. Oh, I see. This is a quote that you cannot read that says, "Buy to the sound of cannons, sell to the sound of trumpets." This is Baron Nathan von Rothschild. It was mentioned 200 years ago. This was an investment strategy of the Rothschild family. We buy where there's war, and then we sell when they're celebrating and happy. And he was right. We found in our data that if you buy in countries where there's government instability, and you sell in countries where there's stable governments, you have a very high return of your money. In fact, the highest of any of our variables. This is interesting because this study is only looking at the top 20 countries mentioned in the news. These are all very liquid markets. The least liquid would be Indonesia and Pakistan, but otherwise they're very liquid markets. And even Indonesia and Pakistan have ETFs that can be traded, so this is quite an interesting strategy. What it does is it looks at the top 20 countries in the news. It goes short the top 4 with the most mentions of instability. I'm sorry, it buys the ones with the most instability, and it goes short the ones with the least instability. This is what we call emotional arbitrage. We're arbitraging the fear of investors based on the news that they're reading about countries. They read bad news about governments in a country, they pull their money out, the market drops. This is a rotational model. This model waits until it hits a critical amount of fear or conversation, and then it buys it or sells it. So we're arbitraging investor emotion in this. This is unemployment, and this is joy. What this means with joy is that we want to short the countries that are the happiest and buy the countries that are the most miserable. Similar to government instability, but less specific. And what's interesting with this finding is that the more extreme the government instability, the better your returns in the financial markets over this period of time. And this is a combination of factors. When a number of different factors are combined, it creates a very smooth curve. This is fit. This is not real returns, and these aren't real returns. This is out of sample. It's been running on our website. We have it all automated. So it's running. It did very well this year because of Pakistan. It was long Pakistan and Russia too. And then right now, then we have this little ranking system, and it's long Russia and Indonesia. Because of Indonesia's sell-off, there was a big unwinding in Indonesia, so it's fairly interesting. But again, this is a arbitrage of investor emotions globally. And it's a one-year holding period, a very long type of arbitrage. So the keys to understanding this are that if you don't reason yourself into a position, you can't reason yourself out. You need a disciplined process as an investor. That process can include other investors' emotions, but it should not include your own excitement or fear or disappointment. It's a discipline. Investing is a business. We also see that investor education is key, but it's really got to address emotional experience. In the case of Walter, in that cartoon that I showed, where Walter's chair was pointing off the cliff, you can tell Walter, "Walter, you're looking the wrong way, you should turn around." That's an intellectual statement to Walter. Walter won't turn around to an intellectual statement. Walter needs somebody to connect with him emotionally before he will turn around. Somebody who understands and tells him they understand what he sees and understand how he feels. Then Walter will turn around. The problem with most investment education is that we're addressing the intellectual, but investors aren't as rational as we wish they were, right? Now, the other issue is that we see in social media and news media that the content of these is exacerbating biases. It's making investor behavior worse, actually leading to opportunities for big hedge funds. And honestly, I sell the data that you saw to large hedge funds. And what they do is they do actually buy equities in those countries where there's government instability using our data as a guide. Now, they are making money off of maybe pension funds or sovereign wealth funds who are withdrawing because they have to, because their investment committees are frightened. And the problem is down to the news, and it's the drama of the news, and fundamentally it's to our biology, that we react all in the same way, at the same time, often out of the same emotions. So I'd love to hear any questions you have. We have a newsletter, an English, of course, newsletter that comes out every month that's free. It discusses how you can manage your emotions as an investor. Please feel free to give me a business card, and I'll put you on our newsletter list if you're interested after this. Thank you.